Hello and welcome to Credit Matters TV. I am Violaine Grimprel from the S&P Paris office. Today we're going to be talking about S&P latest forecast for the Eurozone economy. And I'm delighted to be joined by Jean-Michel, our chief economist for Europe. Jean-Michel, welcome.
Hi.
So in the report you just published, you point out that the length and the depth of the Eurozone recession will depend upon three factors. And the first one is the condition for external trade recovery in Europe. Could you detail this point?
Well, obviously, 2012 was not a very good year from an international trade standpoint. If you look at international demand for European products, it looks like it grew about 3 to 5%, between 3 and 5%. We're waiting for the latest confirmations, which is a very low rate of growth compared to the recent past, when that demand was growing at about 8 to 10%. So that didn't help our economies, for sure, and especially those that are very export-oriented, such as Germany. We do expect a gradual recovery in world trade in 2013. In the US, where the economy should strengthen somewhat in the course of the next 18 months. There are, of course, uncertainties, as we know. And in emerging markets, we continue to receive some very positive signals from China in particular. Industrial production is accelerating. Order books are looking real solid. We think that 2013 and beyond are going to be more favorable years, if you want, where the context is going to be more bullish for European exports. That's obviously one of the prerequisites for a more sustainable recovery in the Eurozone and in Europe in general.
Okay, and the second factor you point out is the joint effect of wage flexibility and price rigidities that depress consumer demand. Why is that?
Well, a lot of focus has been put on wage flexibility since the beginning of the crisis, and rightly so. When you cannot directly affect the level of your exchange rate, which is the case of Eurozone member states. The euro is their joint currency. It's not an individual currency in the sense that you cannot influence the exchange rate level. Well, then what you have generally to do is instead to resort to what would be called internal devaluation. You're trying to achieve the same effect as with an exchange rate devaluation, but via a depression on your domestic costs. And so we've seen, since 2010, nominal wages, labor costs in general, growth in labor costs slowing, in some cases quite meaningfully, and even in some cases in real terms, wages falling also. The problem is that, meanwhile, prices remain much more sticky. You would have guessed, or expected at least, that retail prices would also adjust to much weaker economic conditions. By and large, that's not been the case. Price inflation, consumer price inflation, has continued at a clip that is very comparable to what we used to observe in 2008 or 2010. And that's disturbing.
Well, why? Could you explain us this price rigidities?
Well, of course, the first explanation that comes to mind is indirect taxes. As fiscal retrenchment came in place and various states were trying to raise more fiscal receipts, one of the ways to do that is increase indirect taxes and the VAT in particular. And that happened. It's taken place in most countries. So it is part of the explanation. But interestingly, the European Statistical Office, Eurostat, publishes monthly price indices excluding tax effects. In other words, trying to capture what is what would the inflation rate look like if you exclude the direct effects of indirect tax hikes. And if you look at that, and we've just published those charts, you see that even without those tax effects, inflation remained fairly sticky in most countries. Ireland is a huge counterexample. Prices and wages adjusted downwards very quickly in Ireland as soon as 2010 onwards, which means that the depression on real incomes from lower nominal wage growth and still high inflation was less strong in Ireland than in other countries. But if you look on the other side to Italy, which is the other side, then you see that wage growth actually slowed markedly in that economy in the past 3 years, but inflation remained fairly rigid, which means that you are sort of losing on both scores. On one side, domestic demand is even more depressed because real wage growth is very negative because of sticky inflation. And on the other side, as far as your external competitiveness is concerned, the gains are fairly limited because indeed prices remain quite sticky. Now, that's the description of what's happened. Looking forward, we are now starting to see inflation slowing in most of those economies, especially in the periphery, which leads us to expect the decline in real incomes, and I have to use the words very precisely, a smaller decline in real incomes. In other words, we're not expecting real incomes to grow again in 2013, but we expect real incomes losses to be smaller next year than they were in 2012, and beyond, perhaps stabilizing in 2014. That would be a positive as far as consumer demand is concerned in those economies.
Last but not least, you mentioned in your report the recovery of the monetary transmission to the real economy. Where are we at the moment?
Well, in its July press conference, ECB President Mario Draghi used a phrase that is quite an accurate but strong description of the state of the monetary union. He said that the European Monetary Union, the EMU, was fragmented. What is a fragmented monetary union? It's a monetary union with specific characteristics. One, the transmission of interest rates, of the policy rate of the central bank, becomes dysfunctional. The fact that the ECB rate is at 0.75 percentage points at the moment. That's the policy rate, 75 bips. If you look at the interest rates applied to loans in various countries, you see huge divergence, huge deviation across the union. Second, credit growth is also very unevenly distributed in the union. We have a contraction in the periphery and slow growth in the core or the northern part of Europe. In other words, the very significant increase in the size of the balance sheet of the central bank has not translated into any significant increase in money supply in the EMU. Of course, at the root of that fragmentation, we find heightened concerns about the sovereign situation. And that goes back to the middle of last year when we saw a spike in sovereign rates. The recent announcement by the ECB of a new framework to provide support to member states in the monetary union, the new framework called the OMT, the outright monetary transactions, goes a long way in trying to restore confidence in the Eurozone, restore confidence in interbank markets, and therefore set the stage for a gradual recovery in interbank activity and in credit growth.
Thank you very much, Jean-Michel.
Thank you.
This concludes our edition of Credit Matters TV. Thank you.